Hi everyone. In this video, we will talk about zeroed out GRATs. If you still haven't watched our previous videos on the topic, I strongly recommend you to do so first. We'll talk about what they are, their benefits, and a real-life example. So let's get started. A zeroed out GRAT is a popular option for individuals who want to leave a large sum of money to their heirs without having to pay any taxes on the transfer. To understand how a zeroed out GRAT works, it's important to know how estate taxes are determined and what does a GRAT allow you to do. If you don't do any special planning, your family will owe federal taxes on every dollar over the estate tax exemption that goes from you to your beneficiaries when you pass away. The estate tax exemption is currently $12.92 million for individuals and $25.84 million for married couples. A GRAT allows you to owe tax on only a fraction of those gifted dollars. This means that your estate tax exposure with a GRAT will be equal to the difference between the total trust value plus interest and the amount you actually receive over the trust term. But with a zeroed out GRAT, you can achieve 100% tax-free gifting by ensuring that the present value of the trust's annual distributions over the trust term equals the total value of the property used to fund the trust. Since you, the grantor, receive an annuity equal to what you contribute to the trust, the IRS expects the amount left for your beneficiaries to equal zero. Given this is a zero-value gift from the IRS perspective, though not in reality, because you expect your investments to grow faster than the IRS interest rate, you won't be required to use any portion of your lifetime gift tax exemption. Instead, any assets remaining in the GRAT after the final annuity payment will pass to your remainder of beneficiaries tax-free. To illustrate how a zeroed-out GRAT works in real life, let's consider the example of Garrett, a successful entrepreneur who has accumulated over $50 million in assets. He wants to set up a 4-year trust, and he decides to transfer $20 million to the trust as the initial contribution, because Garrett set up a 4-year trust. Most planners would set him up with an annual distribution equal to $5 million, or 1/4 of the original amount contributed to the trust. If he did that, though, he would end up using a significant portion of his lifetime gift tax exemption. For that reason, a zeroed out GRAT would make more sense. Garrett will take an annual payout of $5 million plus the IRS interest rate of 3.0%, or $5.38 million. As a result, he will use up none of his exemption and pay no estate tax on whatever additional growth he passes on to his beneficiaries. Garrett is a savvy investor and is able to achieve a 10% annual return on his assets, on average over the course of the 4-year trust. At the end of the 4 years, after the GRAT has distributed $5.38 million per year or $21.52 million total, about $4.2 million of investment gains would be remaining. All of that money would go to Garrett's designated beneficiaries, entirely free of federal estate tax. In conclusion, a zeroed out GRAT is a powerful estate planning tool that allows individuals to transfer assets to their beneficiaries without incurring gift or estate taxes. By setting the annual distributions to a certain amount, you can significantly decrease your taxes and reach a zero estate tax on the amount passed to your beneficiaries. All right, that wraps it up. I hope you liked the video. And if you have any doubts, please comment the video, and we'll be happy to help you. Now, a quick word about Valur. We have built a platform to give everyone access to the tax planning tools of the ultra-rich like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. If you still have any questions, you can visit our website at valur.io. You can read our content on tax planning strategies. Play with our online calculator to discover your financial gains by picking different trusts or schedule a call with us.